What are the top three oversight priorities credit union boards can't afford to miss in 2025? Well, before we answer that question, welcome back to Boardroom Minutes, your premier channel for clear, concise insights into the issues that shape today's boardrooms at for profit institutions, nonprofit organizations, and religious institutions such as churches. I would also like to thank all of my new subscribers to this channel that subscribed between my inaugural episode, which occurred on last week, up until today, this second episode. So thank you for subscribing. And for those that didn't have the opportunity to do so, why don't you do that now? Hit the subscribe button as well as hit the like button. Or if you want to wait until after this episode, feel free to do so. And if you find the content noteworthy, then go ahead and hit that like button. Well, what are the three top oversight priorities credit unions can't afford to miss in 2025? Well, I hope to be able to answer that question. And this presentation hopefully will be an essential guidance for directors who are navigating economic uncertainty, technological shifts, and evolving member expectations in today's challenging environment. So, we will be taking a look at three critical areas or three pillars of focus. And these top priorities are financial stability and risk management, cybersecurity and technology oversight, member experience, and regulatory compliance. Those are the three critical areas of focus that we're going to look at as those three top oversight priorities for credit union boards. Now, for those that are joining for the first time, I'm starting out the second episode talking about credit unions because that is where I have most of my board experience. Now, I am a trustee. I'm the chairman of the board of trustees for an international religious institution, but my many years of experience date back to when I was chairman of a multi-billion-dollar credit union in New York City. I also served on a couple of credit union trade boards, and that is where I received the brunt of my experience as a director in the boardroom. So, we're going to take a look at credit unions, but this is applicable for other institutions as well, whether you're in the banking industry or any other private sector industry, or if even you're in a nonprofit organization. This would still nevertheless be applicable. So, why don't we take a look at priority number one, which is namely financial stability and risk management? And you probably ask, well, why is this a priority? Why is it so important? Well, because the economic landscape is constantly changing. The direction of interest rates, as you have seen in the news, are difficult to predict. We see the chairman of the Federal Reserve speak uh, on the various news networks, and there's not a change in either direction, whether up or down. And it's very difficult to predict what the future holds. Also, we have inflation that impacts members' ability to borrow and repay debt liabilities. So that has an impact on the bottom line of financial institutions, namely credit unions. And then also, loan demand can also move in unpredictable ways, especially when we speak of auto loans and mortgages. As such, we have to ask ourselves, well, what does this mean for credit union boards? Well, directors first must know how to read and understand basic financial statements like a balance sheet and an income statement. That's a necessity. You must be able to understand what the key financial statement terms are, so that you can understand the financial condition of the credit union that you have oversight of. And you also have to be familiar with key metrics known as camels. Now, these are not desert camels. Rather, these are camels, which are ratings. And the acronym CAMELS stand for one, capital adequacy; two, asset quality; three, management; four, earnings; five, liquidity risk; and five, sensitivity to market risk. And we're going to take a brief look at each of those five categories or ratings as it pertains to financial stability and risk management. Let's look at capital adequacy. For those that may be a director at a bank and not a credit union, you may identify that as capital adequacy ratio or CAR. But it really means the same thing. And when we look at capital adequacy, it's an important measure or metric because boards must ensure that capital ratios remain strong enough to absorb potential losses. In other words, you don't want to have a crisis occur where there's a run on the bank and you don't have enough capital to meet the demand needs of your members. The capital ratio is typically a measure of the credit union's capital as a percentage of total assets. I'm often reminded of the old movie, Christmas season movie, It's a Wonderful Life. And there you have the Bailey's Savings and Loans. And it was a bank, a community bank, and they experienced a run on the bank where all of those depositors came looking for their deposits. Unfortunately, they did not have enough capital adequacy in order to meet the demands of those depositors. They were able to close its doors without claiming bankruptcy, but nevertheless, they had to scramble and ask the depositors to settle for amounts less than what they demanded. Be it as it may, they were able to survive. But when you are on a board, you don't want your credit union or financial institution just to survive. You want to make sure that the capital that the institution holds is adequate enough to absorb potential losses. Let's look at our next metric, and that's asset quality. And this measures the quantity and the quality of the assets owned by the credit union. And these are typically the loans that the credit union gives or issues to its members. It's also the investments that the credit union may purchase, securities, bonds, other equity products. And directors, it's your responsibility to monitor loan delinquencies and charge offs. You need to receive these reports so that you know the condition of your loan portfolio. You also should receive reports on investments. You need to know whether your investments are gaining or losing. Additionally, board members must also pay attention to concentration risk. What is concentration risk? Well, you don't want to invest in one particular type of asset. You would like to, and we'll touch on this when we talk about liquidity risk. You want to be able to spread out your investment portfolio in case one particular investment goes sour. Your whole investment portfolio is not concentrated in that one particular category of investments. But if it's spread about in a measured and strategic way, if one particular category of investments go sour, you still have your other investments that could potentially make money for the credit union. So you got to pay attention to concentration risk with regard to asset quality so that you're not heavily invested, even when it comes to your loan portfolio. You don't want to be heavily invested in all auto loans in case the auto industry goes sour. You don't want to uh, be concentrated in all mortgage loans because you may have interest rates skyrocket. And as a result of that, you would have members defaulting on their mortgages. So you want to have a healthy spread, a healthy uh, concentration, a measured concentration of your loan and investment portfolios in order to um, limit and mitigate risk. Then we get to management. And let me just first, at the outset, state this important principle that as directors, as a board, you are not responsible for running the day to day operations. That is the role of management, that is the role of C suite managers. However, directors need to oversee how management responds to shifts in business conditions, shifts in the way the institution is operating to meet those member needs and the conditions, the economic conditions, that is. And management needs to hear the right questions coming from the board of directors. This includes asking management for what if scenarios and also approving the strategic plan for the institution. Also, it involves audit reviews by the supervisory committee. Now, the supervisory committee is like an audit committee. It is an audit committee, and most for profit corporations in the private sector have audit committees, but they are part of the board of directors. In credit unions, and mainly in state chartered credit unions, supervisory committee members are independent. They're separate and apart from the board of directors. Federally chartered credit unions, they have supervisory committees that are members of the board. Nevertheless, the supervisory committee operates like an audit committee, and they are there to provide reports, audits of management's operations. And the right questions should be asked by the board of directors when they read those reports from the supervisory committee. And then the fourth camel's metric is earnings. And this measures net income as a percentage of assets. And it also reflects the quality and source of the institution's profits that should be based on sound business practices. This also includes how you are managing your operating expenses. In other words, the quality of your income should be such that it's not relegated to gimmicks or non occurring instances where the institution is making its money, its receiving its earnings, but it should be based on sound business practices so that the flow of net income into the institution is consistent and steady. Also, you need to minimize operating expenses so that those do not get out of hand and negatively impact the bottom line of the institution's net income. And then you have liquidity risk. And we touched on that earlier when we were talking about uh, the loan and asset investment portfolio. You want to make sure that you are not fully invested in assets that are not liquid. You want to have a certain amount of cash on hand just in case there is trouble in the economy and members feel insecure and want to withdraw money. You want to have sufficient cash on hand to meet that demand from members. You also need to have certain investments that you're able to convert and that are liquid, able to convert easily into cash rather than having investments solely that are long term that must come to maturity before it can be converted into cash. So you want to make sure that in times of stress for the institution, you are able to meet your members' needs. Why? Because credit unions are there to serve members. Members are the owners of the institution. And as I mentioned, this includes monitoring the investment portfolio to make sure there are sufficient assets to liquidate if needed. And then there's sensitivity to market risk. This is a relatively new metric, but directors are responsible for monitoring the institution's exposure to market risk. In other words, like changes in housing prices, if there are spikes or drops, and the same with interest rates. So you need to run various scenarios to test and do stress tests to test the sensitivity to market risk. And this includes creating an interest rate risk policy and also strategies on how to mitigate risk with regard to running these various stress test scenarios. So that's camels in a nutshell. And that's priority number one. Priority number two that credit union boards can't afford to miss is the area of cybersecurity and technology oversight. You know, credit union members are unique, or rather, credit unions are unique because their members own the institution. That means members just don't trust you with their money, they also trust you with their personal and confidential information. And that trust is under attack every single day by cyber criminals. Therefore, cybersecurity and technology are no longer just an IT issue, but it is a boardroom issue. And it is a priority of boards to make sure that they're fully engaged in managing cybersecurity risk, making the best choices to leverage technology for the institution. And in their oversight responsibility, directors should have questions for management. One, is management providing the board with continual and understandable cybersecurity reports and updates on risks and defenses? And when I mean continual, I mean up to date reports, also understandable reports in layman's language, because cyber technology language can be difficult and it may go over the average head of a director. So these reports should be placed in as simple language as possible. Also, directors should be asking, is management investing in the right technology? That means you want to balance innovation like mobile apps, AI chatbots with member data security. So, yes, you want to have the latest technology. You want to be able to offer your members the most current and up to date applications, but you also have to balance that with the security of members' data. Because once member data is breached, it is a burden not just on the institution, but the members and what they have to do to go ahead and remedy their personal secured information. Also, directors should ask, are the vendors being used by management in order to supply these technological apps from fintech companies? Are they properly vetted? There have been horror stories where fintechs would come in, they would bring in an application for the institution, and the application just wrecked on the operations of the credit union. So they have to be properly vetted. That's also part of risk management, making sure they are vetted. Also, how is the AI being used? Is it being used to enhance service? Is it staying within compliance boundaries? Or could it expose the credit union to new risks? Are the AI applications causing discriminatory practices? So these are the things that directors questions that they must ask of management. And then these questions should not only be addressed to management, but they should also be reviewed and audited by the supervisory committee. The supervisory committee needs to audit uh, the things that are in place that are related to cybersecurity and technology, and the directors should receive those reports. Now, as a reminder, and I've mentioned this, we've seen headlines where there were breaches, cybersecurity breaches that led to reputational damage. And boards must make sure their credit union doesn't become one of those headlines. Why? Because cyber criminals are very sophisticated, and boards may not be able to eliminate cyber theft, but they can certainly mitigate it. Now we get to priority number 3, and that's member experience and regulatory compliance. You know, credit unions serve to exist to serve members, while regulators ensure strong consumer protection. Balance growth. Uh, there must be a balance between growth along with compliance and innovation with the mission. That's very important. There has to be a balance between growth along with compliance, innovation with the mission. Let me say that again. There must be a balance of growth, compliance, and innovation with the mission, because the mission is people helping people. What should boards consider? Well, they should consider certain regulatory priorities. They should stay current on NCUA supervisory priorities. And the NCUA is the regulator for credit unions, the National Credit Union Administration. And these priorities should be in the areas, especially in areas like fair lending practices. Is the credit union following fair lending practices? Also, consumer financial protection and capital adequacy requirements. We touched on that in terms of the camel ratings. So these are regulatory supervisory priorities that directors need to stay current on. Then there's service innovation. How are members being served? Because members expect digital convenience, such as mobile deposits, online banking, uh, including lending, and even AI driven support. The board's role is to encourage management to innovate while maintaining a member first mindset. So remember, there has to be the balance between growth, innovation, also compliance against member first mindset, member driven mission. What is that mission? What is that philosophy? People helping people. So when we think of mission balance, we also need to think that growth is important, as I previously mentioned, but it's never at the expense of the cooperative philosophy and mission, which is people helping people. Boards must keep asking, are we improving members' lives or are we chasing numbers? Remember, credit unions are not for profit. That doesn't mean it's not in the business of making profit. It just means that making profit is not the primary goal, but the goal is for service. The motto is not for profit, not for charity, but for service. So, what is the takeaway here? Great boards balance growth with compliance and mission. They protect members, they protect the institution, and they protect the mission, which is the credit union philosophy of people helping people. And just as a quick recap, because I like to keep this program within no more than 30 minutes, and I think we're doing okay. So, for a board oversight recap, the three top oversight priorities should be financial stability and risk management, cybersecurity risk and technology oversight, and last, member experience and regulatory compliance. And know that board leadership matters. Your questions, oversight, and leadership impact members' financial futures more than ever. So let me ask you, which priority is most urgent for your credit union right now? All right, that wraps it up for this episode. Again, would you hit that subscribe button? Also, if you enjoyed this presentation, why don't you also hit the like button? And for those that would like to reach me, whether it's for in person or virtual training, or you just want to drop me an email by saying you are enjoying these episodes, you can do that at the CU Evangelist at cuevangelist.com. That's CUEVANGELIST at cuevangelist.com. All right. Thank you for tuning in. Hope to see you on next week with another episode from Boardroom Minutes, your premier channel for clear, concise insights into the issues that shape today's boardrooms at for profit corporations, nonprofit organizations, and religious institutions. This is Mark Brantley signing off.